VAT or value added tax in Dubai is an important topic for every business owner and even freelancers because it can affect your pricing, your cash flow, and your legal obligations. Many people think that Dubai is completely tax free, but VAT is a key part of the country's tax system. In this video, I'll walk you through everything you need to know about the VAT in Dubai, including the thresholds, registration requirement, and how you can stay compliant. Before we start, my name is Shiraz Vahid, and I've helped hundreds of business owners and their families move to Dubai, set up their business, residency, and banking, and legally reduce their taxes. If you want my help in doing the same, you can book a strategy call with me at setuphero.com/call. VAT was introduced in Dubai on January 1st, 2018, at a standard rate of 5%. It is administered by the Federal Tax Authority, also commonly known as FDA, and it applies to most goods and services unless specifically exempted or zero rated. Understanding VAT is essential because non compliance can lead to fines, penalties, and even business disruption. Let's start with the basics. Who need to register for VAT? In Dubai, if your taxable supplies and imports exceed the mandatory threshold of 375,000 dirhams in the last 12 months, that's roughly 100,000 US dollars, you must register for VAT. This means that if your business generates more than 100,000 US dollars in taxable revenue over the past year, you are required by law to register and charge VAT on your sales. This includes not only standard sales but also services, commissions, and any other business activities subject to VAT. If your business's taxable supplies and imports are below 375,000 dirhams but exceeds the 187,000 dirhams mark, you can choose to register for VAT voluntarily. Voluntary registration can be beneficial if you have a lot of input VAT to claim on business expenses. For example, if you are investing heavily in equipment or office space and you're paying VAT on those purchases, voluntary registration allows you to reclaim that VAT and reduce your overall business cost. Now, what counts as a taxable supplies? Taxable supplies include all of the sales of goods and services that are not exempt or zero rated. This means most business activities in Dubai are subject to VAT. Common examples include consulting services, sales of any physical goods inside Dubai, or even digital services that are provided to Dubai customers. It's important to understand your business activities and how they are classified under the VAT law, so this will help you avoid surprises when filing for your returns. Zero rated supplies are taxed at 0% VAT, but they are still considered taxable supplies. This means you must include them in your VAT calculation and the VAT returns, but you don't charge your customer VAT on them. Examples of zero rated supplies include exports outside the GCC, certain healthcare services, and some education services. Understanding the distinction between zero rated and exempt supplies is crucial because it affects your ability to reclaim input VAT. Exempt supplies, on the other hand, are not subject to VAT at all. Examples include residential property leases and certain financial services. If you provide exempt supplies, you cannot reclaim the VAT you pay on your business expenses related to those supplies. This can have significant impact on the cost structure and pricing, so it's important to plan accordingly. Once you're registered for VAT, you must file regular VAT returns. Usually it's quarterly through the FTA portal online. Your VAT returns will show the VAT that you have collected on sales, that's output VAT, and the VAT that you have paid on your business expenses, that's called the input VAT. The difference between these two amounts is what you owe to the FTA or what you can reclaim as a refund. Filing deadlines are strict and late submissions can lead to fines and penalties. Maintaining accurate records is key to staying compliant with the VAT law. You must keep all invoices, receipts, and accounting records for at least 5 years. This documentation proves your VAT calculations and it is essential in case of an audit. Investing in a good and locally compliant accounting system or working with a tax advisor can help you stay organized and avoid costly mistakes. Another critical point to consider is the impact of VAT on your cash flow. Since you must collect VAT from the customers and remit it to the FTA, you are essentially acting as a tax collector for the government. If you offer credit terms to your customers, you might have to pay VAT to the FTA before you have actually received the payments from your clients. This can create a cash flow challenge, so it's important to manage your payment terms and plan finances accordingly. Non-compliance with VAT regulations can result in significant penalties. Late registration, failure to file returns on time, incorrect VAT calculation, and other violations can all lead to fines. These fines can be substantial and can harm your business reputation. That's why it is essential to understand your obligations and seek professional advice if you are unsure about the aspects of VAT compliance. If you're coming from a country with high VAT rate, the UAE's 5% VAT might seem low, but it is still an important part of country's tax landscape. It's also a clear signal that Dubai is aligning its tax system with the international standards, which have an implication for how you structure your business and manage your finances. If you would like my help in understanding the VAT threshold, registering your company with the tax authority, or managing your tax obligations and accountings in Dubai, you can book a strategy call with me at setuphero.com/call. We will build a customized plan that suits your business needs and helps you stay fully compliant. And if you're serious about running a successful business in Dubai, you should really check out my next video right here.